Okay, here we are. It's a second lecture that relates to chapter 1. So you can see we're starting right out with our first transaction. What's the first thing you do? Well, you got to put some money into your business. And in this case, we're saying that Charles Taylor is going to invest $30,000 of his own cash in his new business. He's going to call it Fast Forward. And that business is a proprietorship. In other words, a sole proprietor. And so we're going to look at the accounts, the categories that are involved here. First one is cash. He's putting cash in. That's an asset. And remember now, we have to balance that accounting equation. So he's also going to record his interest, his ownership in the company. So we're increasing cash, we're increasing capital. Both sides of the accounting equation are equal. I'm going to go through these a little bit fast. They're kind of tedious for you, but I think they're important for you to understand that our accounting equation is always in balance. Okay, so we've got this kind of a spreadsheet here. You can see we increased cash 30,000 on the left side of the accounting equation. On the right hand side, we've increased equity, accounting equation again, 30,000 on the left, 30,000 on the right. Everything is in balance as it should be. Well, next we're going to look at some supplies. Mr. Taylor needs some supplies to run his business. He forks over $2,500 of the company's cash. What's involved here? Well, he spent some cash and he got some supplies. Both are assets. They're resources of the company. That's what an asset is. So we reduce one asset, increase another, and the accounting equation remains in balance. So we reduce one asset, increase another, and the accounting equation remains in balance. Well, what else are we doing here? This slide just shows, again, equation in balance. What else are we doing? Okay, we've still got 30,000 on the left. Total assets, 27,500 plus 2,500 equal to Mr. Taylor's interest in his business. 27,500 plus 2,500 equal to Mr. Taylor's interest in his business. Well, Mr. Taylor needs some equipment, kind of pricey. He spends $26,000. What happened? He reduced his cash resource by $26,000, but on the other hand, now he's got a $26,000 piece of equipment. We're going to record it again at $26,000. That's the cost principle. So one asset goes down, another goes up. The equation remains in balance. That's the cost principle. So one asset goes down, another goes up. The equation remains in balance. Here again, just a slide that says, okay, we're still in balance. 30,000 on the left, 30,000 on the right. Here again, just a slide that says, okay, we're still in balance. 30,000 on the left, 30,000 on the right. I'm going to buy some more supplies. I'm going to increase that supplies asset account, but we don't have 7,100. So we're going to set up something called an account payable, something that we owe, an obligation. This is a short-term obligation. An account payable has to be paid off in a reasonably short period of time. The asset goes up, supplies, asset, And the liability, which is on the right-hand side of the accounting equation, by the way, goes up as well. Accounting equation still in balance. And the liability, which is on the right-hand side of the accounting equation, by the way, goes up as well. And this, again, just shows the equation in balance. Now we've got 37,1 on the left, 37,1 on the right-hand side. Just shows the equation in balance. Now we've got 37,1 on the left, 37,1 on the right-hand side. Now we've got some money coming in. That's refreshing. So fast forward. This is a consulting business, a service business. Well, now we've got some money coming in. This customer to whom we provided services forks over cash right on the spot. So we have some revenue here, 4,200. Asset on the left, 4,200 increases. Revenues, remember that's on the right-hand side. That's part of income. Revenues go up as well. Accounting equation still in balance. Remember that's on the right-hand side. That's part of income. Revenues go up as well. Accounting equation still in balance. Here's that accounting equation. Now we've got 41,300 on the left, 41,300 on the right-hand side of that accounting equation. Now we've got 41,300 on the left, 41,300 on the right-hand side. Well, what's going on here? Fast forward has to pay the rent, $1,000 a month apparently. Salaries of 700. So we're going to decrease our cash. You have to pay cash for the rent. You have to write a check, and then of course we have to pay our employees 700. So our cash asset goes down by 1,700. On the right-hand side of the equation, we've got some expense. Remember, that's part of income. Rent expense, as well as salaries expense. Okay, so rent expense increase on the right-hand side, salaries expense increases on the right-hand side. Accounting equation still in balance. Increase on the right-hand side, salaries expense increases on the right-hand side. Accounting equation still in balance. Okay, so you can see now left-hand side 39.6, right-hand side 39.6. Everything's okay. Still in balance. Left-hand side 39.6, right-hand side 39.6. Everything's okay. Still in balance. Well, what's going on here? More consulting services. This is going to be some revenue for us. Well, we're going to rent some facilities for $300. Okay, so this is rent that's coming into us. This is revenue. It's not our usual form of income or sales, but it's still revenue. We're going to call it rental revenue, as opposed to consulting revenue, which is what we're in business to do. But these people aren't going to fork over cash right away. Hopefully we'll get it in a little while. So now we have their promise to pay us a total of $1,900. So therefore, that promise, we call that an account receivable. We're going to get some money. We're going to receive some money, but that asset, that promise to pay us has value. And so our accounts receivable asset on the left-hand side of the accounting equation is going to go up. consulting revenue on the right-hand side goes up as well, as does rental revenue. Again, the accounting equation remains in balance. There's that usual slide shows 41.5 on the left, 41.5 on the right-hand side of the accounting equation.
Usual slide shows 41.5 on the left, 41.5 on the right-hand side of the
Transaction number 9, well, came through our client from the prior transaction,
transaction number
pays
9.
$1,900 for consulting services. Okay, cash goes up, that's an asset. His promise to pay doesn't have to
1,900 for consulting.
pay anymore, his promise goes down. So one asset, cash, goes up, the receivable, also an asset, goes down. Counting equation, still in balance.
Promise goes down, so one asset, cash goes up, receivable, also an asset, goes down. Counting equation, still in balance.
Again, there's that usual slide. Now we've got 41.5 on the left, 41.5 on the right.
Again, there's that usual slide. Now we've got 41.5.
See what's going on here?
5 on the right.
Okay, we're going to reduce our liability for supplies. Okay, remember, way back there in transaction 4, we bought those
Okay,
supplies
we're going to
on
reduce
credit.
our liability.
So our cash goes down, we pay out the money, 900. Our liability on the right-hand side of the equation also goes down. Counting equation reduced cash
Our liability
on the left
right-hand side
by
of
900.
also
Reduce the liability on the right-hand side by 900. Equation stays in balance.
cash on the left by 900. Reduce the liability on the right-hand side by 900.
And
Equation
once
stays
again,
in balance.
now we've got 40,600 on the left-hand side of the equation, 40,600 on the right-hand side of the equation. Everything's okay because our accounting equation remains in balance.
Right-hand side of the equation. Everything's okay because our accounting equation remains in balance.
Okay, here's transaction 11. Our owner needs some money. He's gonna take 200 out of the business. His cash goes down, but his
Transaction 11.
equity,
Our owner needs
his
money.
ownership in the business, remember, we can't commingle personal
His
with
cash goes
business.
down, but his equity,
So we've
ownership
got a withdrawal.
of business,
The
right?
category is
Can't commingle
withdrawals. You can see it right here.
business.
See Taylor withdrawals, 200.
Got a withdrawal.
You can also see that the accounting equation,
Withdrawals.
once again,
Right here.
balance. Now we've got 40,400 on the left, 40,400 on the right-hand side.
Accounting equation, once again, balance. Now we've got 40,400 on the left, 40,400 on the right-hand side.
Okay, this is just kind of a spreadsheet presentation that sort of summarizes all of those transactions
Okay,
that we've just gone through.
kind of a spreadsheet
And
presentation,
We've just totaled them up,
sort of
once again proving
summarizes all
that
those
the accounting equation
that
is okay.
we've gone through.
We've stayed in balance. Assets are equal to liabilities plus equity.
Proving that the accounting equation is okay. We've stayed in balance.
We'll look at
Assets equal
Some
to
financial
liabilities
statements here,
plus
these are
equity.
just reports. They have a specific format. We have to sort of stay within those
We'll look at
parameters or
some
those
financial
guidelines as to
statements. These
how
are just
these
reports.
financial statements or
They have a
reports
specific format.
are
Have
put
to
together.
stay within
These
those
statements are
those
for our own personal use, but also they're for
financial
use
statements
outside
are
of our company. Our banker like to look at them if we're in debt to the bank. IRS wants to take a look at our financial statements. So we're going to put together these basic financial statements and see how they interrelate, how they work together to give a good picture of the health of our company.
Interrelate, how they work together to give a good picture of the health of our company.
And this is an important slide, really tells you what these 4 basic financial statements encapsulate. Okay, so the first one is the income statement. Revenue minus expense, net income. What came in minus what went out.
Okay, so the first one is the income statement.
Revenue minus expense, net income. You can see the purpose over here on the far right hand side. Tells you what the revenues and expenses were and shows how much we made or lost, for that matter, over a particular period of time. Next statement is a statement of owner's equity. Talks about the owner's interest in the business, his beginning capital. Remember, we started with nothing, and then he invested some money. Also, we had some net income, but then again, remember, he withdrew the $200. So we start with beginning capital, add the investment by the owners, also the net income, and then at the very tail end there, he withdrew the 200. We add, then subtract ending capital. Explains the changes in the owner's interest or ownership in the business. Okay. Next one is the balance sheet. This has to do with our accounting equation. Describes what we call the financial position of the company, the assets, the liabilities, and the equity at a particular moment in time. And then the statement of cash flows. This is important. We don't spend a whole lot of time generally in accounting classes at the very start anyway. But the statement of cash flows is very important. You want to be sure you have cash. As soon as you run out of cash, you're out of business. So you start by recording the increases and the decreases in cash. And these are classified as operating increases and decreases, investing increases and decreases in cash, and financing increases and decreases in cash. We combine them to show the change in cash. So here we are, kind of a presentation, formal presentation, to give you a look at what those statements look like. And you can see we start the income statement. Shows our net income, which is encapsulated in the statement of owner's equity, that middle statement right there, and then finally the balance sheet, which uses the statement of owner's equity, incorporates the statement of owner's equity into the balance sheet. Okay. Balance sheet and statement of cash flows, that's a nice picture of what those look like. Get a better look at it in your text, Exhibit 1.10. You can see it's just a formal presentation. It doesn't vary much from company to company. Really only a couple of variations. That format basically is unchanged. You can see the income which was incorporated into the balance sheet, you can see the balance sheet is a representation really of the accounting equation, shows the assets which are equal to the liabilities and equity. If you look at those numbers, you can see total assets there are equal to liability plus equity. And then at the bottom there, you can see those various classifications or categories of inflows and outflows of cash. They're divided between operating, investing, and financing. And that bottom line there is the cash balance at the end of that particular accounting period. And so that's pretty much it for chapter 1 lectures. As we go through the homework, we'll get some additional explanation, which I hope is going to be helpful as well.
That's pretty much it for chapter 1 lectures.